this on 26th November 2022. So this week I took some losses on my trades on uh, GBP USD, Euro USD, and I had to go back to my charts and try to understand why. Because currently we are having a risk on sentiment. The risk on currencies like euro and pound, they are uh, they are heavily buying. And these days it's not possible to succeed as a trader, as a forex trader, using one chart and one form of analysis, because the markets have changed beyond recognition. These trends nowadays, trends are not based on interest rates alone. No, a few years ago, there was a time when the currency which had the higher interest rates uh, would be buying against the currency with the lower interest rate. But nowadays, you have to look at the bonds, you have to look at the commodities, you have to look at the stocks, and now all this will now be reflected in the currencies that you trade. If after analyzing all that, all those markets, the bonds and the commodities and the equities, if now your analysis tells you that it's a risk on sentiment, or it's a risk off, it's a risk averse, now it will be reflected in the currencies that will be traded, because if it's risk off, then you'll be buying the currency like the yen. If it's a risk on, you'll be buying currencies like the Audi, the New Zealand dollar, the Canadian dollar. Yeah. So the bond market will always give us the answer, and it will always help us to know where where the dollar is going. And I always say that if only you know where the dollar is going, all the other decisions will fall in place, because it's it's the king. Let me just say that. Yeah, it's the reserve currency. Most of the products are oil, gold, agricultural products. You know, they all rely on the dollar. So on the bond market, so the long-term bonds, they are falling. Okay, and the thing is that these when the long-term bond yields are falling, of course, this means that investors investors are buying these 10-year bonds and 30-year bonds. Yeah, because you can see the 30-year bond is at 3.7 and the 10-year bond is at 3 point what? 3.69. Yeah. So when the bond yields are falling, this shows that investors are buying these long-term bonds. Okay. What about the short-term bonds? Now, the short-term bonds, if we look at 3 months, okay, it's the opposite. You can see the money is moving out of the bond, which is why the bond yield is rising. Same case to the 2-year bond, 4.4. It actually peaked around 4.8 the last week. So the short-term bonds are rising, and yet the long-term bonds are falling. And I remember I said that when the interest rates rise, they can cause the bond yields to rise. Of course, that is true, and it applies to these short-term bonds. Yeah, because these short-term bonds they are mainly driven by the Fed policy and the Federal Open Market Committee sentiment or the minutes they come out and read or when a member speaks. Of course, that is what will drive these short-term bonds. But for the long-term bonds, like the 30-year bond, see, it's falling, and the 10-year bond, it's falling. This one, the yields are not driven by the Fed, by the Fed policy. They are driven by inflation. Okay, so when you see these investors, they are buying the long-term bonds and they are selling the short-term bonds. Okay, this tells you that in the near future, what we are seeing currently, with the money that is moving out of the bonds and to the stocks, which is now reflected into the risk on currencies like the euro and the pound and the AUD and the New Zealand dollar. That one is based on the short-term move out of the bond market. But for the long term, for the long term, you can see the yields are falling, which means that investors are buying these bonds for the long term. But for the short term, the money is moving out of the bond market into more riskier asset classes. Yeah. But for the long term, the money is moving into the bonds. Okay. Now there is a this means that if we had two investors and investor A invested into a 10-year bond and the second investor B invests into the 2-year bond. Okay. Now, when of course the investor who is investing for the long term for the 10-year is taking on more risk, so we would expect that the rates will be higher. Okay, because if it's taking 10 years, if it's taking more time, of course the rates have to be higher than the 2-year. But currently, what we have is the opposite. So if I invest in a 2-year bond, I'll get a greater return on investment than the person who invests in a 10-year bond. Okay, so that's That's not what should happen. What should happen is that the long-term bonds they should have higher yields than the short-term bonds because the long-term investor now is taking on more risk. So of course the return should be higher. And when you look at March, beginning of March this year, beginning I mean around March, this is a 2 year bond. So this March, let's look at 3 month. So around here, uh, March. So from this point, okay. Now this is the 3 year, the 3 month US bond yield. So at March, this March here, you can see the yield was 0.3. Okay. So from March now, when investors started selling these short-term bonds, they sold. They started selling here. The money started moving out of the bonds this period from March. And when the money started moving out of the bonds, the yields started rising. That is from March this year. Okay, so this is a 3 month government bond. Now, if we look at the 30 year or the 10 year from March, because the 3 month was at 0.3, yeah, 0.3. It was here 0.0.3. You can see. Okay, so for the 30 year at the same period, March. Okay, so draw a vertical line. So here you can see the okay, this March, very much. So here it was 2.2. So when the 3 month bond yield was at 0.3, the 30 year bond was at 2.28. Okay, what about the 10 year from March? Here it was 2.2. Okay, so up to March this year, everything was okay. The long term bond had a higher yield than the short term bond. Okay, and if we were to look at a graph, this is the yield curve. So this is the 3 month currently it's at 4.2. Okay, this is the 30 year it's at 3.6. So this curve it's sloping. Yeah, it's an inverted yield curve. But at around March this year, the 3 month was at 0 point something. So it was here. It was around here. and the 10 year was at 2.2, so it was around here, and the 30 was at 2 point, uh, 2.2 also around here. So during March this year, the curve was, normal curve. It was sloping outward the way it should this way. But now it has come and it has inverted. Okay, which means that the short-term investors they are getting more return than the long-term investors, which is not how it should be. And when normally when we see this yield curve, it normally means that normally, but not usually, that we might be going into a recession. Okay, because these long-term investors they they are buying bonds for the long term. They know that at some point the Fed will start reducing the interest rates. But currently, as of now, the Fed has not come out and and said that they are maintaining. All we can hear is that they will be reducing the rates, but not they're reducing the rate of increase, okay, but not maintaining or actually cutting. So this risk on move that we are seeing we're seeing currently in the market, where the euro and the pound and New Zealand and Audi, they are all rising. This one is based on the short term move, not on the long term move. Okay, so even it means that even the stocks, the way the stocks that they are rising right now, they are based on the short term, the 3 month and the two-year bond yield that are rising. Okay, and when since the Fed has been raising interest rates, this is why that we are seeing that the short term yields they are rising, but the long term yields they are falling. Okay, so eventually, this risk on move that we are seeing, uh, when um, when the Fed now start slowing the rates, and these short-term investors now who are moving out of the bonds, they start moving back now. When now the short-term yields will go now below the long-term yields, and the curve will return to normal. Okay, that is when now we can this risk on move will be over. Okay, so the thing is that these short term these short term bond yields they are rising. Okay, but the long term yields they are falling. Okay, which means that the moves that we are seeing now they are based on the short term yields, but the long term picture is that the investors they are buying the bonds. Okay, but the short term they are selling. And when the yield is inverted in such a way, because it means that we are heading into a recession, and the long-term investors will come out as winners eventually. Okay, so this the short-term move is just short-lived. Yeah, so we'll be waiting maybe at around when the 10 year test this support or the 30 year, maybe then will be the risk on will be over. So we will be out of the market until then. So that's from March. From March is when everything got distorted. Everything was okay